Well, Citi is bullish on the Indian banking story as well as on the Indian financial space, where they believe that financials are going to be the biggest overweight in their India model portfolio. And we take a look as to why. Well, Citi expects banks in FY23 to benefit from a rising loan to deposit ratio. They believe that this particular rise will lead to a growth in top line for pretty much all the banks, especially the larger ones. They expect the largest beneficiary in terms of loan to deposit to be ICICI Bank. They believe that the loan to deposit ratio is poised for a sharper growth in that particular counter. In terms of the other impact of this, they believe that NIMs will continue to grow. They will expand, of course, largely on the back of this particular increase in loan to deposits. And they believe that a NIM expansion of 10 basis points is going to be warranted in FY23. So that is two big positives for the banking space. Citi is also quite comfortable on the asset quality side of things, especially the retail asset quality. They believe that the strength in quality of liabilities in HDFC Bank, ICICI Bank and AU looks quite solid and quite strong. In terms of what the risks are for this space, they believe that spends related to customer acquisition and tech are a risk to earnings. So they believe that OPEX is going to continue to go up, and that will largely be driven by tech spends. Now we already know that tech spends account for around 7 to 8% of the typical OPEX spends for banks, and that Citi believes is going to continue to go up. Mind you, when we look at the peers in the US, they spend around 10 to 14% of their OPEX on tech spends. So Citi believes that India is already lagging on that front and that the Indian banks will catch up towards that 10% mark. Now, when we look at Q3, private banks have reported an increase of 80 basis points in terms of cost to assets versus pre-COVID levels on tech spends itself, and they believe that this will further increase by 10 basis points, which will impact profitability by around 4% for the larger private banks. So that may impact margins as well as profitability for private banks. In terms of general valuations, well, Citi believes that valuations are looking attractive when we compare them to historical levels versus the Bank Nifty as well as the Nifty 50. When we look at the discount there, the discount seems to be larger than what it used to be as per the historical data available. Further, Citi also believes that large private banks are poised for even better growth, 15 to 18% ROE, and that will mean that valuations look even more reasonable when we compare them to the past. Further, they also believe that in terms of mid caps, large caps are better placed in terms of versus their mid cap peers, and that is largely due to a near-term NIM risk as well as the OPEX risk, which we did speak about. Of course, there's one more risk which needs to be kept in mind in the current environment. The geopolitical events, if leading to a macro slowdown, Citi believes that could hamper growth in the near term. When we look at what name Citi is looking at in terms of their top picks, well, they believe that ICICI Bank will outperform even HDFC Bank, and within the mid-cap segment, they like AU Small, so that looks like a decent opportunity. Broadly, Citi quite overweight on the banking space, which looks reasonably valued overall.